gold finally plunged below 2,000 on Tuesday. It dropped about $30 an ounce, and it was trading at about 1990, a little bit lower. And it stayed at that level on Wednesday as well. But on Thursday, it got back above 2,000 and added to those gains today. So it closed the week about $2,013 an ounce. It was actually up about $1 or $2 on the week. And I think that this move below 2,000 could be the final shakeout for gold before it moves up to new highs. Now, the catalyst for that move on Tuesday was, ironically, the release of a hotter than expected January CPI number, meaning that the inflation numbers came out higher than the markets had expected. In fact, they probably expected good news. They probably thought that we'd get lower numbers than was expected, and instead it was the reverse.
In a recent analysis by Peter Schiff, he highlights the puzzling behavior of gold amidst inflationary pressures in the U.S. economy. Despite a brief dip below $2,000, gold surged back above this threshold to close the week at $2,013 an ounce, up slightly. Schiff argues that this dip was merely a shakeout and not reflective of gold's true value as an inflation hedge. He points to unexpected CPI data triggering initial market reactions, noting the paradoxical response where higher inflation numbers led to gold sell-offs. Schiff contends that the Fed's reluctance to raise interest rates further confirms a looming inflation problem, evident in resurgent CPI figures and weakening economic indicators such as plummeting retail sales. Even as gold initially dropped on hotter-than-expected PPI data, Schiff suggests it rebounded, emphasizing the disconnect between fundamental economics and market behavior. This analysis challenges prevailing market sentiments, urging viewers to reconsider their outlook on gold and the broader economic landscape. Don't forget to like, share, subscribe, and enable post notifications for more insightful financial analysis.
Now, I say it's ironic because gold is an inflation hedge. The point of buying gold is to protect you from inflation. It preserves purchasing power. It's a store of value. So it should be good news that inflation is worse than people expected, because that means there's more reasons to buy gold. But the way it's worked for the past year or so is the reverse. It's been higher than expected inflation news that's caused gold to sell off. It's when inflation comes out lower than expected that people want to buy gold. Again, why would that happen? Because it makes no sense fundamentally that that would be the case. Well, the reason is because every time the inflation numbers are higher than expected, the market expects the Fed to have to fight a little bit harder to win the inflation war. And it's that harder fight that gets traders to sell gold. In fact, I don't even think anybody decides to sell. I think it's already programmed into the trading algorithms. Anytime inflation news comes out lower than expected, these algorithms are pre-programmed to sell gold, to buy the dollar, because they think it means a tighter Fed, that it's going to be higher for longer, that we're going to have to wait a little bit longer for the first rate cut, and therefore that means gold's going to have a problem. But the markets still haven't figured out, and I think they will soon, that hotter than expected inflation doesn't mean the Fed just has to fight a little harder to win the inflation fight. It actually confirms that it's already lost. The idea that inflation is going to go down to 2% is farcical. There's no way that's going to happen, and I've been pointing that out. Yes, we went down from 9% to 3%, but that doesn't mean we're going to just glide down to 2%. If you look at all the fundamentals, everything points to higher inflation, a resurgent CPI. If you look at all of the factors that should have been influenced by higher interest rates, because the way higher rates are supposed to reduce inflation is by reducing demand. They reduce spending. They make it more expensive to borrow. And so you borrow less, you spend less. But none of that has happened. Government spending is off the charts. Budget deficits are soaring. The U.S. government hasn't tightened its belt because interest rates have gone up. It just keeps borrowing more. And the same thing with consumers. Consumer debt is at an all-time record high. Credit card debt is at an all-time record high. Even though credit card interest rates are at an all-time record high, that hasn't stopped the spending. And so nothing that the Fed has done is going to reduce inflation. The fact that the official rate has come down from 9% to 3% is not really a function of anything the Fed has done. It's simply the way the market has traded. Nothing goes in a straight line. But what really was responsible for the move down was the anticipation of all the rate hikes. That strengthened the dollar. That brought down commodity prices, oil prices, brought down the headline CPI. But all that is in the past. Nobody expects any additional rate hikes, and nor do I. So the rate hikes are in our past, not in our future, and that means the dollar's going down, and that means the headwind that pushed prices down is now a tailwind that's going to push them back up. In fact, look at oil prices on the week closing above $78, positive on the week, even though stocks and bonds were down. Bond prices also getting clobbered on the week. So rising long-term interest rates, rising oil prices are a sign of resurgent inflation. But so was the CPI number that came out today. In fact, I've been pointing out on my podcasts over the last several months that contrary to the conventional wisdom, inflation isn't heading lower, it's bottoming. It's forming a base, and it's about to head back up, which is exactly what we're seeing. The markets just think that this is an aberration. In fact, Fed officials came out on Wednesday and did damage control. They said that the hotter than expected CPI number doesn't change anything. It's within their expectations, and everything is still on track for rate cuts in 2024. Now, if the Fed really was being honest, they would be hiking rates. They wouldn't even be talking about when they're going to cut rates. Rates are still too low. It's obvious because they've had no effect on slowing down borrowing or spending. Meanwhile, if you look at all the economic data, the manufacturing data, that continues to be weak. And so we're producing less and we're spending more. That's a recipe for much higher prices. And nothing the Fed has done has changed that. But the markets still believe the Fed. They still think the Fed is committed to bringing inflation down to 2%. It's not. It's already surrendered. It's all a pretense that it's going to go back down, because the reason the Fed pivoted and stopped hiking rates was because they didn't want the economy to buckle beneath the weight of rising interest rates. It was already starting to happen. Bond yields were above 5% for the 10-year out to the 30-year, and the markets couldn't handle it. The housing market, in fact, we got housing data that came out today that was the weakest, I think, the weakest January since the COVID lockdowns. And so the housing market is already having a lot of trouble with rates the way they are. The Fed can't afford to raise them, especially in an election year. So the rate hikes are off the table. But the other thing that the markets have got wrong is their outlook for the economy. They think inflation is going to come down, but the economy is still great. We've avoided recession. They're wrong on that too. The economy is weakening just as inflation is strengthening. In fact, look at the numbers we got today on retail sales. They plunged far more than expected, down 0.8. They were looking for a drop of just 0.1. But if you look at X vehicles, retail sales plunged 0.6. They were supposed to rise by 0.2. And X vehicles and gasoline, a drop of 0.5 versus expectations of a rise of 0.2. And they even revised down the prior month. And remember, retail sales are not adjusted for inflation. So even though prices are going up, sales are falling. That means volume is really coming down. And, we got more inflation news today, more bad news on inflation. What was interesting is that after an initial sell-off, gold dropped about $10 when we got the hotter than expected PPI that came out this morning. Gold bounced back. And the dollar, which initially rallied, again, the dollar does the same thing. when there's hotter than expected inflation, people buy the dollar. Why would you do that? Fundamentally, what inflation means is that the dollar is losing purchasing power. And so if the dollar is losing purchasing power faster than you thought, why would that incentivize you to want to buy the dollar? It's a reason to want to get rid of your dollars.
Thank you for joining us today as we explored Peter Schiff's insightful analysis. This week, we saw gold briefly dip below $2,000 before rebounding to close at $2,013, indicating a potential shakeout before an upward trend. Despite gold's role as an inflation hedge, it often reacts inversely to higher-than-expected inflation data, driven by programmed trading algorithms. Schiff highlights the Fed's ineffective attempts to curb inflation, citing persistent market fundamentals pointing towards higher inflation. Weak retail sales further underscore a weakening economy amidst resurgent inflationary pressures. Your engagement and feedback are invaluable to us, so don't forget to subscribe, like, and share your thoughts in the comments below. Until next time, take care and happy investing.